While navigating the financial jumble, index funds shine as sturdy guides. Picture them as a basket holding bits of many companies. They make investing easier, mirroring a whole market and often outshining high-fee managed funds. What is in an index fund? Various strategies are employed by index funds to mirror a market index. One approach involves investing in all securities listed in the index, while another involves selecting a subset of those securities. The decision on how much influence a security has in the index is often based on its market capitalization, indicating the total value of a company's shares. Market capitalization is calculated by multiplying the share price by the number of shares available. In a market cap-weighted index, securities with higher market capitalization contribute more significantly to the index's overall value. Beyond this, index funds may utilize derivatives, such as options or futures, to align with their investment goals. These financial instruments serve as tools to help achieve the desired outcomes within the fund strategy. The inclusion of derivatives allows for additional flexibility in managing the fund's performance and risk exposure. In summary, the choice of which securities to include, the method of determining their weight in the index, and the use of derivatives are key factors that differentiate various index funds in their approach to tracking market indexes. How an index fund works. Indexing involves a different way of managing funds where a fund manager doesn't actively select specific stocks or try to time the market. Instead, they create a portfolio that mirrors a particular index, essentially copying the makeup of the overall stock market or a broad section of it. The aim is for the fund's performance to closely match that of the index it imitates. There's an index and a corresponding index fund for nearly every financial market available. In the U.S., the S&P 500 is among the most popular index funds, but there are several others widely used, like the Wilshire 5000 Total Market Index, MSCI EAFE Index covering foreign stocks, Bloomberg U.S. Aggregate Bond Index for the bond market, NASDAQ Composite Index, and Dow Jones Industrial Average, DJIA, representing large-cap companies. For instance, an index fund that tracks the DJIA would invest in the same 30 big publicly owned companies listed in that index. Changes in index fund portfolios happen mainly when their benchmark indexes change. If the fund follows a weighted index, the managers might adjust the percentages of different securities from time to time to match their presence in the benchmark. Weighting helps balance out the impact of individual holdings in an index or a portfolio. This adjustment process is the main time when index fund portfolios undergo significant alterations. What are some risks of index funds? Just like any investment, index funds come with their own set of risks. These funds face the same overall risks as the securities within the index they follow. Additionally, there are specific risks that investors should be aware of. Index funds may not be as adaptable as non-index funds when it comes to responding to decreases in the prices of the securities in the index. There's a possibility that an index fund won't perfectly replicate its intended index. For instance, a fund might choose to invest in only a portion of the securities in the market index, resulting in its performance being less likely to align precisely with the index. Index funds could fall short of matching their target index, and this could be due to various factors such as fees, expenses, trading costs, and tracking errors. These risks collectively impact how index funds perform. While they aim to mirror the market or a specific segment, the challenges of perfectly aligning with the index, a restricted ability to adapt to market changes, and the influence of different costs can cause variations in their performance compared to the intended benchmark. It's crucial for investors to carefully consider these risks alongside the potential advantages of investing in index funds before making informed decisions. Lower costs. Index funds have a major edge over actively managed ones. They come with lower management expenses. These expenses, bundled in the fund's expense ratio, cover various operational costs like payments to advisors, transaction fees, taxes, and accounting expenses. Unlike actively managed funds, index fund managers don't require research analysts or personnel involved in picking individual stocks. They trade holdings less frequently, resulting in fewer transaction fees and commissions. Actively managed funds, on the other hand, maintain larger teams and conduct more trades, which ramps up their operational costs. These management expenses impact the fund's overall expense ratio, ultimately affecting investors. Consequently, index funds, known for their affordability, often charge less than 0.65%. Typical rates range from 0.17% to 0.4%, with some firms offering even lower expense ratios of 0.05% or less. In contrast, actively managed funds usually command higher fees, typically ranging from 0.77% to 1.36%. The expense ratio plays a significant role in a fund's performance. Actively managed funds, burdened with higher expense ratios, face an uphill battle in matching index funds in terms of overall returns. For those interested in index funds, online brokerage accounts often provide tools to explore available options. The benefits of index funds include lower risk through diversification, cost-effective expense ratios, strong long-term returns, and suitability for passive, buy-and-hold investors. Additionally, they offer tax advantages for investors.